Hello, good people. How are you? I hope you are doing fine wherever you are. I am the ACCA tutor, Mr. Mutimkulu Jerry. Okay, and in this video, we are going to delve into two accounting standards. That is International Accounting Standard number 8, accounting policies, changes in accounting instruments, and errors. And International Accounting Standard number 10, events after the reporting period. Okay, so these are the two standards we are going to focus on this week. All right, and I'm sure you guys have received the notes which are relevant for this week's work. All right, and your assignments are now ready. So you just have to check up because we don't have time. We are only left with now about 5 week study. Okay, just 5 week study because we are aiming for the June exams, which means we need to push such that by end of April we are done. We need to call this syllabus done. All right, and this is how we are going to do it, guys. We need to ensure that we meet the syllabus deadlines, and we just have to dedicate a lot of time, about a month, doing revision themes. Okay, we need to revise the whole syllabus, doing some mocks and so forth, such that on exam day nobody should be caught unawares. All right, so we are going to focus on these two. All right, IAS 8 and IAS 10. If you guys are finding this video to be very useful, if you are new here, new on this channel, and you're finding the videos very useful, please do not forget to subscribe, like, and share, and even comment on the comment section provided. Right. So my name is Jerry Mtipkulu, as you can see on the screen, and those are my numbers and the email address which you can use to contact me or the school. The school is actually Transkyle Consulting, Transkyle Business School. Okay, it's a #1 online Zimbabwean domiciled school. All right, so we are in Zimbabwe, but we have got students dotted around the globe, which means even if you're in Afghanistan, Yemen, the Cayman Islands, Australia, wherever you are, we're going to give you all the assistance you need online. All right. Remember, digitalization has actually enhanced the, the globalization of services. All right. It has actually furthered that concept where we see the earth as a village. All right, so we are part of one community through digitalization. All right, so let's move on, guys. The learning objectives for this week. All right, so by the end of the week, we need to understand the definition and application of accounting policies. We need to explore changes in accounting estimates and their impact on financial statements. All right. So you can as well see that all these are talking of IAS 8. All right. We need to identify accounting errors and how to correct them. Accounting errors, and we are still at IAS 8. Then, lastly, we need to gain insights into events after reporting period and their financial reporting implications. So this is what now this is dedicated to IAS 10. So these are the only objectives, ladies and gentlemen. which we need to ensure that we achieve by the end of the week. All right, so it's actually one can be forgiven to say I started on autopilot. I was not pinned this time around. I was a free man. It's a very short exercise, isn't it? So let's move on. An overview of IAS 8. Now, what is the purpose of IAS 8? IAS 8 provides guidance on the accounting treatment for accounting policies, changes in accounting estimates, and errors. So as an accountant, you should be able to know how you are going to treat the changes in accounting policies, accounting estimates, and when errors occur, what should you do? All right. So, of course, there are no changes in accounting errors. There's nothing like that, isn't it? So changes only apply to policies and estimates. But when you talk of errors, there's something else, isn't it? But you as an accountant, you should be able to account for these three things, right? So we are looking at policies, estimates, and errors. Okay, now what are the key concepts? The key concepts are these ones, right? As you have seen on the screen there, I've listed them. Policies, estimates, and errors. Now let's look at them one by one. Let's start with accounting policies. What are policies? Accounting policies are the specific principles, bases, okay? Principles, bases, conventions, rules, and practices adopted by an entity in preparing and presenting financial statements. While we know that accounting as a field is regulated by standards as well as legislation, we need to take this point at the core of our hearts that companies still have discretion. But this standard is simply saying that when you have that discretion, please tell us what was the discretion. All right, what was your policy? You're allowed. Most of accounting standards give you discretion, give you some choices. Which model do you want to use, and so forth. So you just have to tell us in the financial statement the models which you have used. For example, you might have used the cost model for accounting for non-current assets, or you could have used the revaluation model. So that's your policy, right? So you need to tell people how you are accounting. What your policies would be, all right? Okay, sorry, I was attending to a colleague. Now, you then need to understand what um, policies are. You need to know what they are. All right, so I've listed examples of policies. We might be having a policy in terms of expense recognition. All right, so expenses do vary, but there are some which require some policy. All right, for example, the policy could be dictated or sanctioned by a standard. For example, if we are looking at the interest expense, normally interests payable are considered finance costs. But if we are looking at certain interest that is payable on loans which were utilized on qualifying assets, those interest payments or those finance costs have to be capitalized. All right, they are capitalized. Okay, by capitalizing, we are simply saying they are made assets. Okay, they are made part of non-current assets, or they are made part of the carrying amount of property, plant, and equipment. So, well, the company has no choice there, but it is to state clearly that they had, they capitalize all interest, or let me just say, all borrowing costs, or borrowing costs related to the construction or acquisition of certain property, plant, and equipment. Are we together? Yes. So that's what we are talking about there. We recognize the expense as part of the carrying amount of the assets. If the expense was related to borrowing costs for qualifying assets. Right? And I'm sure we covered borrowing costs in the previous week or weeks, right? Because there was a lecture on borrowing costs, and you guys don't act like you're now being confused and so forth. All right, these things are interlinked. All right, don't just tell your mind that hey, we are on IAS 8, so let us just concentrate on IAS 8. No, it doesn't work like that. These standards complement each other. Then there is also non-current accounting models. All right, so policies on non-current assets accounting. Okay, for example, at the start of this video, I indicated that you might have a policy of treating your PPE at, using the cost model or the revaluation model. All those are allowed by IAS 16. But you need to tell us which model are you adopting for particular assets. All right? Which models are applicable for particular assets, right? Because classes of assets are going to be treated with a similar model. So a class of assets has to be treated using the same model. You can't have, let's say you have got trucks, all right, or haulage trucks as part of your motor vehicles, right? But one of the trucks is using the revaluation model, then the other is using the cost model. It doesn't work like that. The whole group of those assets should be given or should be treated under one policy. All right, so this is why we have said that the policies should be applied consistently to ensure comparability over time. All right, this also applies to other standards, like, for example, IAS 40. Okay, there is also a cost model and a fair value model. You need to ensure that, or to tell the users of financial statements, which policy is your organization adopting. All right, there are policies also linked to the valuation of inventory. We might be valuing our inventories using AFCO or the FIFO. You need to tell your users beforehand what policy you are using. Policies also affect presentation. Okay, we need a presentation policy. For example, if you are looking at an expense like depreciation, where are you accounting it in the statement of profit or loss? Is it part of the cost of sales or an admin expense? Okay, here we just put depreciation as an example, because you discover that in some questions it will be part of cost of sales, in others admin expenses. Okay, so you need to be clear on the policy you are adopting so that the users of financial statements are going to be assisted. But it doesn't mean that you are going to adopt that policy forever. Sometimes, with the change in the business model you are following, or in the change of the operational, or I mean, of your operation capacity, sometimes you are now expanding. Sometimes, because of technology, a certain model might not be working for you, or because of certain macroeconomic variables, a certain model won't be useful. For example, if you were using a cost model for your buildings, you might say, sometimes because the values of properties are increasing exponentially, to continue using the cost model might not then, sound well, might not be reflective or presenting uh, a fairer view of a fairer or faithful representation of your uh, account. Then you might discover that you need to change your policy from the cost model to the revaluation model so that your account or your financial statements speak some uh, relevance in them. All right. So to present a true and fair view, you then need to ensure that your policy is actually meeting the qualitative characteristics of useful information. So you need then to address or to change the policy to something that is more relevant. Now, should that happen, should the change happens, what do you have to do? But let's first look at the circumstances which might lead to a change in accounting policy. Maybe there could be some new IFRS or some amendment of the IFRS. In that case, you have no choice but to change your policy. I have given you an example of treatment in the finance costs. In prior years, before the coming of IAS 23, interest payments were just considered part of ordinary interest. But because of IAS 23, interest payments on borrowings linked to qualifying assets, they are now being capitalized as part of the carrying amount of those assets. So you can see that IFRS sometimes end up forcing us to change our policies. Well, to some extent, you can change a policy voluntarily, okay, for better presentation. Remember the aspect of faithful representation. We just want our financial statements to be reflective of good, highly qualitative, useful financial information. So we then adopt a voluntary change to our policy. So when a change happens, what do you do? You need to apply the change retrospectively, which means the prior year financials would also require a change until the date of the affected transactions. So we need to restate prior period financial statements as if the new policies had always been applied. We need to adjust the opening balance of retained earnings if retrospective application is impractical. So sometimes you can't, go back to over 20 years. Some of those some of those accounts might have been destroyed because in many jurisdictions, tax laws maybe require 6 years retention of financial statement. So you can't keep them forever. All right, you might not have the digital space or the uh, the investment required in keeping those, even the warehouse to keep those financials. Sometimes it becomes impractical. There are companies who were established in 1870 which are still running by now. All right, so we can't sometimes continue to dig and correct all those financials. Sometimes it's not practical, it's not useful even to the users. So what you do is you just have to adjust the opening balance of retained earnings if retrospective application is impractical. Okay, so be in mind that accounting policies, when they are changed, the treatment is retrospective. Now we are at the change in accounting estimate. But first of all, let us define what an accounting estimate is. An accounting estimate is an approximation based on the best information available at the time of reporting. Examples, we are looking at depreciation estimates, where we are estimating the useful life of an asset. But on depreciation, there is always a trick question that comes. Is a change from using the reducing balance method to straight line method a change in accounting policy or estimate? Ladies and gentlemen, this is a change in accounting estimate. I don't want you guys to fail that question because in your assignment it's there, okay? But just to test if you watch the video, you are going to fail. All right. Some of you are going to find this I mean this question challenging and are going to fail it. But it is always going to come even in your actual examination. A lot of people fail this part, this question. They think if we are changing from reducing balance or from straight line method to reducing balance method, we are changing a policy. No, that's not a policy. Why? Because it simply means that we are still depreciating the asset. But what has changed is our estimation of the useful life of the asset. Right? So the reducing balance method is usually adopted when the useful life of the asset is very short, all right, or when we know that in the beginning or in the asset's initial years, the use of this particular asset will be high and it starts to deteriorate with time. So we use what is called the reducing balance method to match the usefulness of the asset with the revenues it is associated with. All right. But if the asset has got a steady lifestyle, lifetime, or let me just say useful life, then and it is usually going to be there for a very long time, then the straight line method is usually justified. All right. So the when we are changing from any of these methods, some of them, the digital, whatever, the life digit method and so forth, all those methods are going to be estimates. They are changes in accounting estimates. Okay, sorry, on digits, it's actually sum of digits method, sum of digits method. Okay, it's also part of it's also a depreciation method which normally used. All right, the sum. Yes, don't like it's sum of digits method. So if the end it says that they are moving from this to straight line method, they are still depreciate. They are still doing depreciation. So they haven't changed anything. There's no, that's not a change in accounting policy, but it is a change in accounting instrument, right? So what should they do, right? They adopt what is called prospective treatment, right? They adjust the current period financial statements, but there is no restatement of prior periods. That's prospective treatment. We correct our position now and go forward. No looking back, right? So we have given you the example of depreciation, provision for doubtful debts, all right? Warranties, all those things. They are just accounting instruments. All right. Of course, there should be some disclosure of the nature and effect of the change if it is material. Let's look at this other animal. Okay. Errors. An error is a mistake made in the preparation of financial statements, such as mathematical errors, incorrect application of accounting policies, or misinterpretation of facts. How do you correct such an event? Let's look at prior period errors. You correct these by adjusting the opening balance of retained earnings in the earliest period presented. Excuse me. So you can see that this is almost equal to the treatment for policies, for a change in accounting policy. So we use retrospective treatment. We would also be interested to go deeper to those financials where the error emanated from. So we do the retrospective treatment. What about a current period error? Okay, this doesn't involve prior periods, but we have discovered the error in the current year. What do we do? Current period errors that are discovered in that period should be corrected before the financial statements are authorized for issue. We don't have to say, no, it's just an error. Let the board sign and so forth, and we correct it in retrospective in the next year. No. We stop whatever we are doing and address the error there and there. We do not allow the executives to sign the financial statements. We have to correct them. Okay, we do not, wait for the board to sign those statements, but we should correct it. All right, we correct the error first and then pushed for the financials to be signed. Are we together? So how do you disclose the error? You have a description of the error and its correction disclosed in the statement of changes in equity. That's the SOC. Statement of changes in equity. I'm sure I am being heard. Okay, this is much detail which you can as well make use of, right? So that's additional information. Prior period errors are dealt with by restating the opening balance of assets, liabilities, and equity as if the error had never occurred and presenting the necessary adjustments to the opening balance of retained earnings in the statement of changes in equity. Restating the comparative figures presented as if the error had never occurred. Disclosing within the accounts a statement of financial position at the beginning of the earliest comparative period. In fact, this means that three statements of financial position will be presented within a set of financial statements. That is, one at the end of the current year. All right, this is the current year financials. So there should be the current year statement of financial position. Then another statement of financial position at the end of the previous year. And then another statement of financial position at the beginning of the previous year. We would need three sets of statement of financial position. Three sets of statements of financial position. All right, so that's how we are going to treat this error. Okay, before we go to IAS 10, I think we need to do an example so that you guys appreciate. So we are going to open the Kaplan start text just for an example in the Kaplan. Okay, those are the useful books you need to have. You guys, you just buy them from their website. All right, so let us use that example. All right, so just 1 minute as I'm opening the book. Okay, ladies and gentlemen, we are here. Okay, we are here, ladies and gentlemen, and sorry, I don't know what's happening. I'm looking for my face, but I can't find it. I'm sorry for the glitches. I'm trying to zoom in. All right, ladies and gentlemen, this is a question from the Kaplan texts. Okay, Kaplan FR. Okay, Kaplan ACCA FR. Start texts. All right. During 20X1, a company discovered that certain items had been included in inventory at 31st December 20X0 at a value of 2.5 million. But they had in fact been sold before the year end. All right. So from that reading, I'm sure you need to show the examiners that you are understanding what it means, because by the end of the day, you need to identify the error. Then after identifying the error, you ask yourself, what is the accounting impact of the error? Okay, so here the error was discovered. What was the error? There was inclusion of closing stock, in the financials for the year ended 31st December 20X0. Okay, closing stock was included. So it tells of error, closing stock included. When? 20x0. Okay, so that was the error, right? So in the financials for the year ended 31st December 20x0, closing stock worth 2.5 million was included. But what is the impact? Okay, if closing stock was included, what is the impact of that inclusion? All right. So if we include closing stock or if we increase closing stock, it simply means that we are reducing profit. All right. We are reducing profit. No. If we're including closing stock, I'm sorry for that. If we're increasing closing stock, therefore the profit is increasing. Profit increasing. All right, the profit increased. So in 20x0, there was overstatement of profit. All right, that was the error. All right, there was overstatement of profit. In that case, the cost of sales were understated. All right, are we together? The cost of sales was understated. The profits increased. Why? Because the sales were being regressed or were being merged with reduced cost of sales. So there was a high gross profit and ultimately even the net profit. All right. Why? The costs were so low. All right. The costs were so low. So obviously the profit is to increase, isn't it? But somebody might be asking, why are you saying if closing stock is increased, there is going to be high profit? So let us prove that empirically. Let us do the computations. I think I need some blank page. Right? Let us test this hypothesis for the benefit of everyone. Okay, let's say let us do two statements of profit or loss. SPL1, SPL2. Okay, here the sales were 3 million. Okay, we are in thousands. So the sales were 3 billion. Here sales 3 million. Okay, we are in selling them in thousands. Then let's talk of cost of sales. The cost of sales are made up of opening stock. The opening stock at the start of the year was 500,000. Then we made purchases. We add purchases. The purchases were let's say 2,000. All right, purchases were 2,000, and then the closing stock. Okay, let us add up here. We have got 2.5. Then we less closing stock, CS. Closing stock, the closing stock, we said it was 1,000. Okay, the closing stock was how much? $1,000. All right. So what is our what would be our cost of sales? Remember, we are computing cost of sales. So 2.5 minus 1,000, we get a 1.5. all right, and the gross profit. Let us, stop at gross profit. The gross profit here becomes 1.5. Why? Because we have separated 1.5 from 3,000. Okay, the 3,000, the sales less the cost of sales, we get a gross profit of 1.5. Now let's finish up the other side. Right, on the other side, the cost of sales, okay, which is made up of the opening stock. The opening stock was 500 as in the statement of profit or loss 1. Okay, as here, that's 500. Then the purchases were 2,000. Just as that, we add up, we get our 2.5. But now this time we are lessing the closing stock. Closing stock this time is 2.5. All right. The closing stock is 2.5. We have increased the closing stock. All right. Want to see what is going to happen. So it means our cost of sales, all right, cost of sales becomes 0. All right. Has become 0. So if it is 0, therefore the gross profit is now 3,000. So what I want you to see is when the cost of sales, when the closing stock, this is the closing stock, ladies and gentlemen, when the closing stock increases, the gross profit increases, or the profit ultimately, okay, increases. When the cost of sales is low, the gross profit is also low. Did you get that? So this is why I said, initially they overstated, okay? They overstated the profit by overstating the closing stock. They said there was closing stock of 2.5 million, when in actual fact, that all that had been sold. All those goods had been sold. There was no such closing stock. It was an error. Are we together, ladies and gentlemen? So you need to understand this. This is the very important concept. We did this in our previous studies, maybe at financial accounting level. That's when we did this statement of profit or loss, including the opening stock plus purchases less closing stock. That's when we did that. But they are still applicable even at this stage, but you just have to figure out as quickly as possible what is going on, because in the examination there's no time to do all these proof and so forth. You're not going to get any marks for this. So I just presented so that you understand where we are coming from and where we are going. All right, let's finish our question. So that we catch up with the time, because time is not on our side. Right. So this is why I said that in 20x0 there was an overstatement of the profits. So the adjustments required is to reduce those profits in 20x0. They have to be reduced. How do we reduce them? We need to add the costs. We need to inflate the costs with the same figure which was used to inflate the profits, the 2.5 million. All right? Okay, so that's what we are going to do, ladies and gentlemen, as part of the adjustment required. So how are you going to do that? Here you can see this is the solution, because the question had actually said you need to show. Remember, okay, let me just show you the full question so that you appreciate what's going on. All right, so we are given these two statements of profit or loss. All right, let me clean up this part. Right. So as you can see, ladies and gentlemen, we are having right. So this is the SPL 1, and this one is the SPL 2. Okay. The other one is for 20x0 and the other one is for 20x1. All right. So the sales this time were 48,300, and the cost of sales here the examiner has only put in total. This is the total cost of sales. So all those additions, the opening stock plus purchases minus closing stock has been done for you by the examiner. So you just have to know that these are totals. All right? But being totals, those items apply. All right? You just have to have those those accounts playing in the back of your mind. So less cost of sales of 30,200, we get the gross profit of that and the tax impact, and you get your 13,800. Remember, these are millions, so it's 13,800,000. All right. Then in the year 20x1, we have got that, and those are the figures. Now, the retained earnings at 1st January 20x0 were 11.2 million. The cost of goods sold in 20x1 includes the 2.5 million error in opening inventory. So you can see that that error has got the, some, recurrent impacts, right? It was committed in 20x0, but it is still having some impacts continuously. All right. So we are being told that the retained earnings figure for 20x0 was 11.2 million. That figure needs to be adjusted, ladies and gentlemen. Why? Because it is continuing. It is having an error in it. Right? It is being inflated by the closing stock, which was never there. Then the cost of goods sold in 20x1 includes as well that same amount. All right. So you need to show the 20x1 statement of profit or loss with comparative figures and the retained earnings for each year. Disclosure of other comprehensive income is not required. Assume that the adjustment will have no effect on the tax charge. That's an assumption you are allowed to have by the examiner. All right. So we come here, ladies and gentlemen. This is the solution. All right. So remember in our notes, we were told that to correct an error, you also have to, you have to go to that earlier period where the error occurred. All right. So this is what we are actually doing in practice. Okay. So this is the statement of profit or loss for the year 20x0. All right. The sales had no problem. Okay. The problem was with the cost of sales. Why? Because we said that there was a certain inventory amount when that was not existing. Okay. So the sales, just take the figure as it is because it had no errors within it. All right. Now, you then have to correct the figure, the cost of sales figure. How are we going to correct it? Remember, initially it was 30.2. million, but we need to add the 2.5 million. All right. By adding, we are actually increasing the cost. All right. We need to increase cost. We are increasing the cost, but we are not increasing the closing stock. Please get this right. In my example, I obviously it would have been erased, because that's the nature of this Google slides. All right, but let me just do it quickly for you. All right, we are simply saying, but if you still remember, you can actually replay it. I said when, all right, from the information given, they said that the closing stock was actually put in 20x0 when it did not exist. It was in error. So they recognized closing stock of 2.5 million, which was not there. All right. So in actual fact, they had increased, okay, they had increased closing stock by 2.5 million. And this led to increased gross profit. Gross profit. All right, so that's what they did in 20x0. But now, let me put the figures. So the figures were, for example, all right, let me just say the sales were 3 million, okay? Just a hypothetical analysis, all right? And the cost of sales, let us just use, this is just a hypothetical analysis. The cost of sales, let's say we say the opening stock, the OS, was 500. Then the purchases were 1,000. All right, let's say the purchases were 1,000. Then we get our 1.5. All right, and the closing stock was 2.5. Let us use the 2.5 which is in the question, and this has to be deducted because we say less closing stock. All right, also remember that this cost of sales is actually sales less cost of sales. All right, the cost of sales is a negative figure. So here we had obtained, let's say 1.5. All right, it's actually impossible to say that the cost of sales were so higher. All right, let us not make it, let us put the purchases here to be, we can put them 2.5. All right, we don't want a queer figure here. All right, so if we add 500 plus 2.5, that gives us 3,000 here, right? Okay, 3,000. So obviously we would have obtained a 500. All right, and then our GP, the gross profit, being 3,000 minus 500, should have been 2.5. All right, so the question is saying this 2.5 did not exist, right? Did not exist. All right, so by putting the 2.5, we had obtained a cost of sales of 500. By recognizing that we have got this stock, then it simply means that the computation for cost of sales arrived at $500. All right, but the examiner is saying the 2.5 you are seeing there did not exist. All right, the idle position was according to the question, the idle position was, let us start from this. Okay, right, Okay, let us start from the 3,000. The ideal position was 3,000 minus the cost of sales of 0. All right, so which means we should have had a 3,000 there. All right, there should have been a 3,000 here. All right, so if the 3,000 was there, it simply means that we're going to have 0 gross profit. Sorry, 3,000 minus 3,000 should have given 0. All right, so what it means is if the cost of sales had been 0, then the gross profit would have reduced to what? To 0. All right, so the error has to be corrected by adding back the 2.5. So if we put the 2.5, all right, if we put the 2.5, it simply means that what we are increasing is not the cost of sales, but the closing stock. Okay, let me do it here. All right, I found another page. All right, now, all right, so we are told that in 20x0, okay, in 20x0, the closing stock, which was fictitiously included, okay, was 2.5 million. All right, and this inflated the profit, right? Increased profit by 2.5 million. All right, but now by inflating profits, we simply mean that we deflated cost of sales. We reduced the cost of sale. All right, so what do we need to do? All right, what do we need to do? It means we need to reduce. We need to reduce what? Closing stock. And increase. So we need to reduce closing stock and increase costs. Why? Because the cost had originally been deflated. We want to inflate it. So we need to increase it. So this is why you are seeing the cost of sales being added with a 2.5. All right. So let us use the figures again to actually see mathematically if we are correct. So be patient. So I'm being forced to come up with a full statement of profit or loss. All right. So sales, let's say sales 4,000. This is hypothetical again. Then the cost, remember this is less cost. All right. So the cost we are having the opening stock 500 purchases. The purchases are 3,000. All right, we get 3.5, 3,500, and then less closing stock. The closing stock this time is 2,000. All right, let us put 2,000. All right, and here we are going to get the ultimate cost being 1.5. All right, 3,500 minus 2000, that's 1.5, isn't it? Then we put in bracket because we are saying the cost, the figure is in a negative. So here we are getting our gross profit being 2.5. Okay, that's 4,000 minus 1.5. All right. Now, okay, it was actually going to be beneficial if we simply use the 2.5 in the question. All right, let's just use the closing stock of 2.5 in the question. All right. Now, the cost of sales initially was 1.5 in error because we had said that it's the 2.5 closing stock there did not exist. So we are saying to correct that error, we need to add, right? We need to add back. We need to add back the 2.5, right? Now, do we add the 2.5? That's the question. Do we add the 2.5 to the closing stock, or we are adding to the cost of sales? All right. What we do to add to the cost of sales, we need to subtract the 2.5 from the closing stock. All right. So this is what happens. I want you to be very careful there. Because the 2.5 here, this 2.5 you are seeing, was put there in error. All right. We need to remove that 2.5. How do we remove the 2.5 there? All right. So the model SPL should look like this, right? These are the sales. The sales are 4,000, right? And the cost of sales this time we are having, let me just say cost of sales, right? We are having the opening stock, that's 500. The purchases, that's 3,000 as given, all right? And we get our 3.5. All right, that's our 3.5. And now this time, let's closing stock. The closing stock, because we have removed the 2.5, should come to 0. If it comes to 0, it means the cost of sales would be 3.5. Why? Because we are saying 3.5 minus 0, so it comes to 3.5. So the ultimate gross profit should now be lower, right? The gross profit should be lower. Why? Because if we reduce closing stock, the profit, the ultimate profit, is going to be low as well. Okay, so this time the profit has reduced to only 500. All right, so what has happened? If we are reducing, if we are here, because the closing inventory in 20x0, the closing inventory we said we didn't have. All right, so we need to remove the closing inventory. By removing the closing inventory, all right, we are reducing the profit. As you can see mathematically in the red part there, the red part, we have reduced the closing stock to 0. Therefore, the ultimate profit, the gross profit, has also reduced to 500, from 2.5 to 500. Have you seen that? I'm sure you did. Okay, now I want you now to understand the mathematics. All right? Remember, we are saying less cost of sale, less closing stock. If we are saying less closing stock there, all right, so we are simply saying that closing stock is already negative in this formula, or is already what? Negative. but we want to reduce it. How do you make it 0? All right, the other question. Here, let me just write it down. The cost of sales was 1.5. So let me just say cost was 1.5. All right, cost was 1.5. But when we reduced it, it became here, according to here, the cost became, when we reduced it, became 500. I mean, when we reduced the closing stock, the ultimate cost became 500. Right. So you can safely see that the cost itself had been added. All right. We had added the 2.5. That's what happened. To actually make this figure from minus 2.5 to 0, we had to add the positive 2.5. The figure, the closing stock figure there in that formula, all right, okay, another school of thought. Let's talk of our course. Sorry, I put 500 there. It's actually 3.5. Okay. Yes. Sorry. There was an error here. The mathematical error. Okay, we are saying just 1 minute. Closing stock there. Right. No, it wasn't an error. It's fine. It's fine. The cost was that. The cost here was 1.5. No, here there was an error. Actually, here there was an error. Okay, it should be 1,000 there, not 1.5, because that's 3.5 minus 2.5. That should be 1,000, right? And the profit here was 3,000, because the difference should be mathematically showing the 2.5. All right, so here is actually 1.5 there, right? So good. All right. So I wanted you to appreciate that to reduce this, all right, we are the 2.5 there, all right, which was not supposed to be there. To reduce that, we actually have to we can mathematically say, all right, we can mathematically say that we actually have to, I mean, we need to separate the 2.5 there further by another 2.5. You can do that one mathematically. So what it means is your figures, if you list your cost of sales figure, remember we are saying we are starting with the opening stock of 500 plus the 3,000 purchases, right? Minus the 2.5 originally, which was there, all right? Then plus the 2.5. Why are we saying plus 2.5? Because we want to remove this negative already in existence, the negative 2.5, which was never there. So we need to add the 2.5, all right? And we get a corrected figure of cost of sales. That's what we are simply saying, all right? So here I wanted to remove it, provided you have put all those computations in brackets so that you end up having a 0 there, all right? Anyway, that's the hypothesis of it. Now let's get back to the reality. Sorry for your time there. Now the reality is that I just wanted you to understand why they were adding the plus 250. The idea is to remove the cost of the closing stock, which was previously there. So if you are removing the closing stock, you have actually seen that if we are removing the closing stock, we are actually reducing the ultimate gross profit. This ultimate gross profit, because we have removed the 2.5 of closing stock, we are going to have a reduced gross profit. Check here. Initially, the gross profit was way higher. The gross profit was 18,100. But because we have removed the closing stock associated with that year, then the gross profit in that year is also going to reduce. But how do we remove the closing stock? We need to add, we add back the closing stock. All right, we add back the closing stock figure. Remember, the closing stock is negative in that formula. We say less closing stock. But now we are lessening. We had lessened the closing stock that was never there. So to make it a 0, we need to add back. So this is why they are adding there. Please get me right there. This is why they are adding that. Okay, so this was done, all right? They added, this figure was given in the original amount. The original amount of 30,200, we saw it in the original statement of financial, statement of profit or loss, it was there. But you then adjust it with the closing stock. The closing stock has to be added. Why? Because in the formula of cost of sales, the closing stock is negative, is lessened. We had lessened a closing stock that was not in existence. So we need to add back. By adding back, we are now inflating. We are inflating the cost of sales now. Okay? Yeah. We are inflating the cost of sales. All right? We are increasing the cost of sales. All right? We are adding back the figure that had been deducted without cause. It had been deducted without cause initially. All right? We had deducted the 2.5, saying there was closing stock. All right? But it wasn't there. So we need to add back. So if we are adding back, all right, we are actually removing the closing stock. All right? We are removing the closing stock. Remember, the closing stock is negative. So if we want to remove it, we add, okay, negative plus positive, we are reducing the figures, isn't it? Negative figure, then subject it to a positive figure. Obviously, those figures are not going to increase in whatever direction they were, but they are reducing themselves, isn't it? Good. Now, we did that for year 1, I mean the year X0. Now let's do for the year, let's now do it for this, but this other year. So obviously the net profit, as you can see, has reduced. Why? Because of that 2.5 adjustment. Remember, initially the net profit was 13.8, but because of the 2.5 movement, we have reduced the closing stock. Therefore, the profits are going to suffer. In 2001, we take the sales figure as they are, 52,100. Okay, 52,100, because the sales have no problem. We are happy with them. So we just take the figure as they are. But the cost of sales now, this is the problematic figure. So we need to address it. All right, we take the figure, this one is, it was reported, but we need then to reduce to this figure now. This time around, we need to reduce it. All right, we had inherited an error. But to correct that error, we had positively, we had added, we had inflated the cost of sales. But this time around, we are now reducing the cost of sales to ensure that the financials this time are true and fair. So you can see that because the cost of sales is now reduced, the gross profit is now increased. You can compare with the initial gross profit, which was 18.6, but this time around it is now increased to 21,100. The tax, these ones were said not to be changing. There was no tax impact, so you just take the figures as they were, and we arrive at that the net profit. But you then have to also do some adjustments in the statement of changes in equity. So we are having the retained earnings there, all right? The retained earnings there. We are having the opening retained earnings, all right? As you can see on the screen there. Let's start with the 20x0, right? So as previously reported, right? The net profit previously was this one. This was the opening, because the question told us that the opening retained earnings were 11.2 million. All right, so you just have to slot in that figure as it is, 11.2 million. All right, then as restated, all right, this figure, you then have to put the corrected net profit for the year. This is now the corrected. Why? Because we are being told, as you can see there, it's 11.3 million. This is the adjusted net profit after doing all those adjustments. Right, sorry, showing unnecessary text there. Okay, then you add up, you arrive at the closing retained earnings. Then you come to the 20x1, you do the computations as well. Now, for this, you just have to be careful there. All right. This was the opening. This was the opening retained earnings at the start of 20x0, right? This is at the start of 20x0. But during the year, we obtained a net profit of this much. So we need to then say, okay, so we need to then say we add with the net profit for the year. But the problem is, if you simply do that, you are going to contravene the disclosure requirement. The disclosure requirement says that you need to tell us the prior period adjustment which you have made. Remember, we said that you need to disclose this in the statement of changes in equity. Please replay that part of the video. So if we come back to that, you see that instead of just taking these two figures, the 11.2, right, this one and that one, and put it straight on this line, we need to input the wrong, okay? You input the originally stated the 20x0 net profit, okay? This is the 13,800, all right? That wrong net profit, you need to put it as it was. Remember, those are the openings, right? But then you then put an entry of the prior period adjustment, the 2.5. Why are we putting it in negative? Remember, initially, because it was part of the closing stock, it had inflated the retained earnings. So now we want to reduce those retained earnings by the same figure. So this is why we are putting it in negative. Are we together, ladies and gentlemen? Then after that, you arrive at this same figure. All right, so that's the restated retained earnings. Okay, the restated retained earnings. This is at the start of 2001, and this is also the closing retained earnings for 2000 or 2010, whatever. So for the 20x0, that's the opening retained earnings for this year was actually the closing retained earnings for the previous year. So this is why you are seeing these figures the same there. And those are the figures we are seeing on top there. I'm sorry for that. I thought we were going to this SFP. Okay, don't worry. So basically, these are the figures which we are seeing. They need to speak to one another. The closing should be the opening, all right, in the coming year. All right, then we add this year's profit of 16.5, and this has also been found as the closing for the 20x0 year there. Okay, and we get the closing retained earnings. So it's about opening balance, then add the net profit for the year, and to get the closing balance. So there is a also another example in the notes I've given you about these similar treatments. All right, you need to be very, very careful about prior period errors. They're going to come in your examination, and I'm sorry, there have been some glitches in explaining these concepts. You know, sometimes they end up like, draining all your energy, but it happens. Now let's try to move on to the other segment of the area which we needed to cover. To cover in this week. That is IAS 10. I think IAS 10. Sure, you guys still have that energy. IAS 10. Let us just have a bit of it. IAS 10 is not a problem to most of you guys. All right, IAS 10 talks of events after the reporting period. All right, and you need to understand what this standard addresses. So it addresses the events that occur after the reporting period and their impact on the financial statements. Now, what are these events? These are events, both favorable and unfavorable, which occur between the reporting date and the date on which the financials are approved for issue by the board of directors. So you can see the standards are related, but they are heading different directions, okay, in terms of their purpose. All right, they are somehow related, because when we talked of the errors, we say that if they are currently period errors, you don't have to pass the financials to the board for its approval. Before you correct those errors, you need to correct the errors and then, excuse me, forward the financials when they are now correct. Now, in IAS 10, we need to understand the two key concepts. There is a concept uh, of adjusting events and non-adjusting events. Adjusting events are those events which provide additional evidence about conditions that existed at the end of the reporting period. Examples include settlement of a legal dispute. The dispute could be settled after the year end, but there is usually a possibility that this legal dispute would have been existed at the end of the year. All right. So the settlement is just providing additional evidence that a dispute was in existence at the end of the year. Are we together? Now, like I said, these are events which occurred after the reporting period, but before the financials are passed for approval by the board, are issued for approval. Uh, okay. These are events which occur between the reporting date and the date on which the financial statements are approved. So it's actually between the reporting date and the date for approval date. Okay, so all those events which occurred during this time are called, or let me just say, are subject to IAS 10. They might be adjusting or non-adjusting events. So adjusting events are those which provide evidence of existence at the reporting date. They provide evidence of conditions which existed at the reporting date. The reporting date is the date, or let me just say, the end of the financial year of a particular company. Okay, this could be 31st March or 31st December. It doesn't need to be 31st December. Companies have got different reporting dates. So this is the date when the financials or the financial year of the company ends. All right, that's the reporting date. It's different from the date on which the financials or the financial statements are going to be approved by the board of directors. Are we together? So something might happen along the way before or between that period. And this is why this standard is essential. So if there are adjusting events, you need to adjust the financial statements to reflect those events. So I gave you the example of a legal dispute which is settled after the year end, or the discovery of fraud. Fraud could have been committed during the year, but it is discovered after the reporting date. We need to adjust our financial statements accordingly. Then impairment of assets. Some assets, there could be evidence that, oh, these assets have been impaired. All right. So in that case, we need to adjust the financials accordingly. By adjusting, we are simply mean that we need to change the figures in our financial statements. All right. But if they are non-adjusting events, then the treatment would be different. These are events that occur after the reporting period but do not relate to conditions existing at the end of the reporting period. Examples: natural disasters. These ones would have occurred after the year end, but before the financial statements are signed, but cannot force us to adjust the financials because they never existed. Nobody was planning that a flood was going to occur. All right? So they're not going to affect us, but we can disclose them if they are material. All right? We can disclose them if they are material. By disclosing, we are simply saying we need to have a note in the financial statements about them, provided they are material. Issuance of shares, all right, or proposed dividends. Remember, dividends are accounted for on a cash basis or on the cash basis. So a proposed dividend is not going to be a liability. If after the year end the directors propose a dividend, do not recognize a liability, a dividend payable. Why? Because dividends are accounted for on a cash basis. You just have to disclose them. So those are the things we need to understand. Okay, spoken about this. Disclosure of events after reporting period. Adjusting events. You need to adjust the financial statements and disclose the nature of the event. Okay, so for adjusting events, be careful. There is an aspect of adjusting the figures as well as some note. You need to put a note for full closure, isn't it? Then non-adjusting events, disclose the nature of the event and an estimate of its financial effect if possible. Events occurring after the reporting period but before the approval of the financial statement must be disclosed, right? It's just some repetition or some emphasis, okay? Provided they are material. So in terms of disclosure, that's good practice. Both the adjusting and non-adjusting events have to be disclosed for disclosure, isn't it? But non-adjusting events are not going to, to affect our figures. Don't think that an event, just because it is an adjusting event, then it should be, it should not be disclosed. It should be disclosed. Are we together? So on top of the adjustment, you then need to disclose, make some disclosures about it. Now, a question might come that says, which of the following should be disclosed in the notes to the FS? When the ACCA tutor is saying that both events should be disclosed, what shall we do? Yeah. Okay. In those situations, okay, you just have to understand that adjusting events have to, affect figures. All right. So non-adjusting, on the other hand, affecting notes. That's the default position. So these ones have to be disclosed. So right away, you need to pick the non-adjusting events as those which should be disclosed. All right. The disclosure related to adjusting events is just to emphasize what has already been recognized or has already been presented. All right. So disclosure on adjusting events is not really essential. What we want is the adjustment to the figures for adjusting events. Non-adjusting events, that's when we need to look for materiality. They should be material. So if they are material, then you need to disclose them. How do you disclose them? You need to disclose the nature of the event and an estimate of the financial effect, if possible. The reason why we say if possible, there sometimes it's impossible to get the estimate. But what you need to then mention is that you need to tell the user that it was not possible. It was not possible. You need to be clear to get the financial estimate, to get the estimate. So the financial loss could not be quantified. Okay, so correct this position. Events occurring after a reporting period but before the approval of the financial statement must be disclosed. We are talking of the non-adjusting events. That's the default meaning of that statement. All right? Disclosure of adjusting is just to add more flesh, to add more understanding, but adjusting events do affect the figures. They simply mean that the financials need some adjustments. Okay, there is an animal called going concern. All right, sometimes examiners test you on going concern. If it is inappropriate to continue treating the entity as a going concern, what it means is that there is no purpose to disclose, no purpose to disclose. If the use of the going concern assumption is no longer appropriate, no disclosure. What you simply need to do is to prepare the financials on a break-up basis. This is also a trick question in the examination where the examiner simply says, oh no, ABC Limited, the accountant at ABC Limited has discovered that the preparation of financials on a going concern basis is no longer appropriate. So they have disclosed this note in their financial statements. Were they correct? The examiner says, were they correct in the disclosure? They were not correct, that's the answer. Why? Because they should have prepared the financials on a break-up basis. So it's not always about disclosure, and so forth. Okay, are we together? So the examiner would have given you a scenario that after preparing the financials, but before they are submitted for approval, the accountant discovered that it's no longer appropriate. Okay, then he just, entered a note in the financials to say that we are sincerely regretting to inform you that, to inform the users of the financials that the ended going concern is now inappropriate. They should have corrected that error. Remember, I told you that you do not, give the board of directors incorrect financials. You need to give them correct financial statements. So instead of giving them wrong financials, you then have to come back, sit down, and prepare financials on a break-up basis. Are we together, ladies and gentlemen? Thank you then. So that's the summary on the screen there. IAS 8 focuses on accounting policies, changes in estimates and error corrections. Changes in policies are applied retrospectively. Changes in estimates affect only the current period, that's prospectively. Then errors are corrected by adjusting the earliest period presented, that's retrospectively. In the exam, please do not forget this. IAS 10 governs events after the reporting period. Adjusting events are reflected in the financial statements. Yes, reflecting, that's adjusting those figures. Then non-adjusting events are disclosed. I rest my case. All right. Do you still have anything? Nothing. So this simply means that we have concluded, we have done justice to ourselves, we love our lives. So guys, until next time, please continue to feel excited. I mean, very, very excited. I aim. Before I say that, I want you guys to know that the ACCA tutor is so friendly and ready to mix and mingle with the students. I need you guys to be part of Transkyle Business School. Transkyle Business School. Okay, we are just taking these steps slow but sure. I know one day we'll reach there. So this is my number, +263 774 596 368. So until next time, ladies and gentlemen, please continue to be safe. Continue to love yourselves. Continue to love yourselves, guys. Life is precious. Life is good with you alive. All right? Always don't forget to pray your God. All right? I'm signing out. Goodbye.